Well, hi everyone, and welcome to the orchard on the rancho where we have peach trees, cherry trees, plum trees, apple trees, fig trees, and lots of citrus. And well, this year we even added a pear tree. So just a nice place to stand and do a video today. And welcome to the Eco Investment Update for May 22nd, 2016, and let's leave the theoretical world of, well, philosophy and economic philosophy from last week, and let's get grounded back to the real world of what's going on today in the markets and in investing. One of the big themes that we've carried through since the reporting season of first quarter earnings came, I guess that started happening about April 15th or so. The first earnings started rolling in from the first quarter and actually hit a crescendo about the first week of May, but earnings are still trickling in, and by and large they've been so-so, but the real theme that we've talked about is the tremendous stress that's occurring in the retailing world, and it's a theme that I've been hitting on for almost a year now on the channel, and it certainly has carried over to the stock prices, with a lot of pain being visited even on the big names, the Macy's, the Kohl's, the Nordstroms, the so-called big boys of retailing, as more and more retailing moves online and moves out of brick and mortar. So the changes are going to be titanic in the economy, and they're being felt in places like malls, as malls continue to shrink and more space becomes available. But the good news is this sort of de-emphasizing the huge mega stores, the Macy's, the big department stores, etc. And it's going to go back to emphasizing the small mom and pop stores that really have something unique to offer in retailing. And because of the decline in the value and the cost of renting space, it's going to be a real bonanza for them to come in and get cheap retail space. And we'll bring that personal touch back to retailing again, that really cool touch of, well, things that are unique in the marketplace, as opposed to, well, when Macy's and Nordstrom's and your Kohl's, etc., go into the marketplace on the wholesale and the manufacturing end, they're all drawing from the same manufacturer over in places like China and Bangladesh and places like that. So this will give a little chance for a little more differentiation in the marketplace, and a chance for, well, new products to come forward on a very local basis, and that's what will make retailing fun again there. Well, the downside of all of this calamity in the retail sector has been a general depressing of the market. We hit 18,050 or so, and we've dropped back about 500 points to 17,500, and it's to be expected. Why? Because I knew, as I talked about a month ago, that when the first quarter earnings came out, they would act like a depression on the marketplace, and the boo birds and all the pessimists would start coming out of the woodwork and telling you, oh, the world is ending and I'm selling everything I can get my hands on. Now the optimist looks at the last month and says, hey, we're only about 3%, 4% from an all-time high, and that's pretty darn good. This market is holding its ground well, even in the face of a supposed a supposed June interest rate increase. You know what? The market is still holding its ground relatively well. Why? Because when you're talking about basically 0% interest and a 1.85% 10-year bond, if you're talking about zero on the shortest end and 1.85% on the 10-year, that's still very low interest rates, right? It's almost like they're paying you to take money and do something with it. So if the Fed raises interest rates another 0.25% in June, it's not going to make a big deal. I mean, the people will panic in the short term, boo, but I'll tell you what, the market's not going to flinch in the face of a 0.5% interest rate. You start talking about 4, 5, 6%, then you have something to worry about. So, again, the theme continues to be very little competition for investment dollars, and certainly the bond market shows signs of being Well, a place that's going to be a low reward venue going forward. I mean, if you have a 10-year note at 1.85%, and there's not a lot more downside on it, there's not a lot more juice in the melon, so to speak, if interest rates go lower again. But there's a lot of pain coming if interest rates happen to move higher, which eventually we know that they will. So you don't want to be on the wrong side of that equation. As I've said over the last 3 months, if you haven't refinanced or bought, now is an ideal time to do that. Refinancing much more so than buying, because I'm still not crazy about real estate over the long term. But I am crazy about the fact that if you owe money, it's a beautiful time now to refinance. Take out a loan consolidation, something to pay off your high interest bills and get a nice low rate financing there going forward. It's a no-brainer. As far as the market continues to go, the oil prices they're still nudging around $50 a barrel. I say big deal on that. There's plenty in the ground, there's plenty in storage, and it's only to be expected after that huge drop we had in December and January. It's only natural to have a reflex, a rebound. We'll see what happens though as supply starts coming up again and companies start rationalizing and putting more product out on the market. I tell you, it's going to be a losing game long term, especially when you consider solar and other alternative energies that are being explored. So it's going to be interesting to see how far this rally will go before it turns down again and tests the $26 a barrel level that we hit in January. As far as the markets go, I'm not going to be one of those negative Nellies. Oh, the world's coming to an end because, retailing has been weak and everything else. So I'm going to tell you now, beware. If you're expecting a collapse or something like that, beware of a market that beautifully holds its ground within 2 to 3% of an all-time high. That's a market that the probability is going to go higher as opposed to go lower. We're clearing earnings season now, so the proof will be in the pudding now to see if we once again get the bit in our mouth and move higher in the market. Well, we'll know in a week or two when I come back with you guys. So I'm still staying long with my mad money, long and crazy here. Of course, I took, as I said, 2 months ago when this rally had run its course the last month or so, 6 weeks. You should only be playing with money that you can afford to potentially lose now because we're in a high-risk zone. I cleared off my low-risk stuff for retirement. I'm just playing basically with, mad money now, and I don't want to take any chances with, my important retirement and other things. So if I'm correct on the market, we've got a long way to go here, and a little bit of my money will go a long way to enhancing the total return of my portfolio. Gold and silver continue to hold their ground well too. They're almost like lookouts on the front deck. Sometimes the seas of finance are quiet, and sometimes they're stormy. So it's like gold and silver sort of float up and down with that. So everybody's kind of holding their breath in this economy to see what's going to happen next. See you guys in a week or two. Thanks.